Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Close Show. As always, Scott Carson, excited to be here today. And today we've got a very special guest here. He is a powerhouse in the real estate investment community. He is based in Northeast Wisconsin. That's right, Wisconsin, the land of cheese
Wisconsin.
curds and the Packers. You know what I
Ah,
mean?
yeah. Oh,
Oh,
yeah.
yeah, exactly. And you
You
guys know
betcha.
we. Love it, love it. He's the host of the Wisconsin Investors Podcast. There's a great job on there. It's a weekly podcast. You should definitely check it out. But I love the fact that he owns several companies in and around his area and really is dominating that market. I know that you guys have reached out and said, hey, we'd love to hear more about some operations and people that are focused on specific markets. And we haven't really had anybody on to talk about investing in the Wisconsin market. Not quite my homeland of Minnesota, but I can put that draw when I need to. But he doesn't talk with an accent like that anyway. So we are honored to have the badass, the legend, Mr. Corey Reyment, joining us here today. What's going on, Corey? How you doing this
Hey,
morning?
man. I'm doing well, Scott. Thanks for that intro, dude. You're making my head get a little bit bigger here. I appreciate that.
I'm available for birthdays and bar mitzvahs if you need and now in this corner.
That's right. That's right. Absolutely. I always think of those old WWE. I used to watch that all the time growing up, and they, hailing from Northeast Wisconsin, weighing in at 200, whatever. Yeah. You did a good job
Exactly.
with
In
it.
the red trunks, in the
That's right.
red onesie,
That's
exactly
right.
going from there. That takes us back anyway. But talk about your journey, man. I mean, I love your marketing and what you've done to really hone in on, hey, this is my piece of the pie, my patch of land that I'm going to dominate, and kind of talk how you got that, how evolved, what you do beforehand to get where you're at. Because I don't think any investor's ever born. We're always made from the school of hard knocks in one way or another, right?
Yeah, 100%. Actually, if you guys can hear a little piano in the background, I don't know if that mic's picking it up at all, but we have our piano teacher here for the kids, and she's like, "Hey, how did you get into real estate? Actually, were you always in real estate?" And I was like, "No, honey, I have an exercise management degree, putting it to work now in real estate." So yeah. So I mean, long story tolerable. I started out in the exercise fitness world. Didn't like that very much. Ended up moving into sales. I was always good at sales and did inside sales for several years, and then got fired from one company for being unemployable basically and asking too many questions. Classic entrepreneur. And then yeah, worked for another company, did inside sales, kind of outgrew it, got bored with it. I was number one sales rep there 3 years in a row, and I was like, all right, there's nothing else for me here. I got to do something different. And had been doing network marketing on the side as well, and got a little taste of that residual income coming in from the network marketing. And I loved that, but I hated chasing people down. No disrespect to anybody doing network marketing. Just for me, it got a little bit like my posts on social media from that era. I'm like, could I please just delete those? Can those go away?
Were you kind of the creepy guy following up with everybody trying to draw circles and how everybody's going to be a double diamond distributor of some
Yeah.
sort back in the day?
Double
Same here,
diamond
man. Been
distributor.
there,
Yeah.
done that.
Platinum. We're going platinum, baby. Come on. Yeah. And we actually did, my wife and I, we actually did really well with it, comparatively speaking to, statistically speaking. But it just got to be a drag, man. But the residual income part of it got me thinking. And I'm like, we started having kids, and my daughter was getting, I think she was 3 years old when my intensity level to get out of working the normal career path from like a 7 to a 10, because she started getting involved in like dance things. And I was working nights and weekends and holidays for the career I was at. And, I was selling these recruiting packages to high school athletes and their families who wanted to promote themselves to college coaches. And it was like, man, my daughter's in like a recital right now. Now I got to go ask off of work to go like watch her do her dance thing. And I was like, I can't do this forever. And my wife, back up 10 years prior to that, right before we got married, she got diagnosed with appendix cancer.
Mm.
And so that moment kind of woke us up too, of like, oh man, like this could be gone in a flash. We don't want to wait till we're 65, drive around in an RV for a couple of years and die. Let's try to figure out a way to live as best we can while we can. So all of that residual income, the cancer, the unemployability of myself kind of led us to read Rich Dad Poor Dad. And like every other investor you probably had on here now on almost 1,000 episodes, probably a good chunk of those people started with Rich Dad Poor Dad or listening to the Note Closer show, maybe one of the two.
Got
One
a
of the
few of
two.
those, but Rich Dad Poor Dad probably beats us by a sliver. You know what
Maybe
I
a
mean?
little bit over that, just a hair. And then from there, it was just really that was the mindset shift or the vehicle that we're like, okay, network marketing was good, but I think real estate's the vehicle that's going to get us there. And that really kind of started us off. And So we started doing direct to seller marketing 2016, and had no clue what we were doing. We had a mentor, but it wasn't like they were like coaching us all the time, kind of a thing. It was like they got us started and got us the paperwork we needed and that kind of thing. But as far as like how to actually like negotiate what is a good deal, we kind of figured that out, and a lot of podcasts, a lot of other listening, doing those kinds of things. And yeah, we started out, we wanted to do the burr process. The goal was to get 100 units as quickly as possible, making $200 a door net, put our feet up on the sand and drink some Coronas for the rest of our life and retire. And we got to 100 doors within 3 years, and then realized, well,
It's a lot of work, man. 3
yeah,
years.
it's not how it worked. And it's
That's
not
3 a
how
month, buddy. That's churning and burning, buddy. Wow.
Yeah. We got the 100 doors. We did not get the 200 net cash flow we thought coming in on those 100 doors, but it's been good. I mean, it's all good. And it got us started. We started wholesaling in that process as well with some of the ones that we were getting under contract, and we just were like, well, we have no use for this. A 1-bedroom house was the first one that I wholesaled, and I had no use for that as a rental at the time. And that really, we really enjoyed the wholesaling piece of it for us. That really led us up. So now our team's about 15 employees strong. We do about 4 million in revenue a year and wholesale fees in Northeast Wisconsin. And yeah, it's been a crazy journey. We got about 140 units that we own ourselves, with no partners or anything like that. So it's been a wild ride, man.
Now on those 140, of those all, I assume they weren't all free and clear. Or was that a list that you were targeting was free and clear or anything like that? What's been your best list to help you with your deal flow?
You know what? It's been all over the board, honestly, Scott. Like when we started it, our first list we ever had was just the absentee owners list. Started handwriting letters to tired landlords because we were looking to pick up those 100 doors. So we figured
is it the famous yellow letter?
Oh yeah, 100%, dude. Yeah, and my wife was actually at the time like literally handwriting letters. Our first
in red ink. You're like, hi, my name is Corey. My wife blank. When I want to buy your house.
100%. And then she's like, this is not sustainable. So she figured out with our printer at the time how to make it look like it was handwritten. Some people were smart enough and they'd turn it over because it was marker, they'd turn it over and there was no bleed marks through. And they're like, this isn't, they'd send us back the nasty, like, this isn't a real letter kind of thing. But yeah, then we started like, we're like, okay, how do we, it just started like that to scale. It was like, okay, now who could do this for us? So we don't have to be copying all these things. And we hired somebody to handwrite the envelopes. Some stay-at-home mom was doing that for us for a while, and it just kind of kept scaling from there.
Now, did you just target your local area? And can you define your area a little bit for those that are listening out there for the most part?
Yeah, so our office is in Green Bay. Go Pack, go baby.
Go Packers. Yep, there you go.
Yep. And that's really like where we started, was the county that Green Bay's in. And then over the years, it's evolved to more of a surrounding counties thing. We now advertise on TV, so it's wherever the TV channel hits. It's kind of our market now. But
how expensive is that compared to the direct mail side of things? Is it more effective? Does it obviously does it cost more, cost less compared to what you're paying out monthly in stamps and envelopes and red ink?
Yeah, our current budget, we spend about $28,000 a month on TV right now. Okay. Our direct mail is about $15,000, so less. But when we look at the return on ad spend, they're both right now performing pretty comparatively. The challenging part is making sure where our team is attributing the lead properly. So when it comes in, it hits our dial pad system and it's attached to whatever that lead source is. Or if it comes through a web form, the job of our team is to ask, hey, how did you hear about us?
Right.
Have that conversation, because a lot of times it'll show up as a PPC lead. Well, it really was because they got a mailer and they just went to our website and filled it out. So that's one of the hardest parts, I think, with when you're spending, marketing dollars, is making sure you're attributing it the right way, so you know where to put your dollars to work.
Sure. Have you figured out, I'm sure you have, knowing your numbers you're rattling off here, kind of what your cost per lead and cost per closed deal is on your marketing side?
I could pull it up real quick. I think our cost per lead, it fluctuates between like 500 to 750, I think, per lead. Cost per contract, TV's higher, but there's more volume with those TV leads. So I want to say those are anywhere from 3,000 to maybe 5,500, depending on the marketing channel.
But that's good. I mean, you're making more than it. Obviously, it just takes that. I'm always amazed at the amount of people that won't spend $10 or $99 on something. And you're like, how do you expect to get by, or how do you even have
Right.
any success if you're not going to market, you
For
know?
sure. For sure. I think that's one of the challenges with wholesaling too, is there's a lot of quote unquote gurus out there that say, oh, this is the free way to get started in real estate, or the no cost way to start in real estate investing. And I'm like, okay, if you want to grind, like there's a cost to everything. Your time, you can go through for free. You can go through apartments.com and try to find some ugly looking units that are available and try to call that seller and ask them if they want to sell versus rent and do that. But that's a grind that takes time. So, there's a cost to it one way or another, but people who are
Well,
trying to do it without spending a dollar, it's going to be it's a
it's
tough.
a complete uphill, vertical, not gradual, vertical uphill
Yeah.
aspect of things of doing it. And marketing is always one of the biggest keys that people don't understand. I mean, I think a lot of people get into the nuts and bolts. They want to learn how to evaluate a note, how to evaluate a rehab, how to evaluate a wholesale deal. But the whole marketing and outreach aspect of it, I think that's really what drives more than anything else that people
Mhm.
really sleep on. It's the thing I think they need to spend more time on, huh?
For sure. Yeah, exactly. Exactly. 100%.
Now, besides you've been doing this now for 9 years, which is awesome.
Mhm.
Congratulations there. What's the long-term goal? You said 200 units or 200 doors. Like, no, I don't want to do that. What's
Yeah.
the 5-year, 10-year plan or the ultimate goal for you guys?
Yeah. I mean, the wholesale business is, I think there's a cap to how much we can grow. There's only so many houses in Northeast Wisconsin, and I think we already get a pretty large chunk of the market share. We definitely have competitors out there that are getting deals that we're not and that kind of thing. But overall, we're continually, I feel like we're getting good return on our ad spend. We're doing a good job with that. So I think there's only maybe another million we could pull probably from Northeast Wisconsin if we get really super dialed in and continue to increase the marketing to that, really figure out what is that, diminishing return mark. Outside of that, for me, we're actually in the process right now, at the time of recording this, to hire a commercial acquisitions agent, get back into our multifamily acquisitions and get back to doing some of that stuff. So I was going to do it. I love doing it. I love sales. I love getting involved, but I made the decision and 3 weeks went by and I didn't make a single phone call. And I was like, I'm just, dealing with the employees and all these other things that come up and whatever. And I'm like, you know what? I got to hire somebody. I have a who problem right now. I got to hire a who
Oh,
to
Huda,
I
exactly.
got to hire a who to take this problem off my plate because I'm not going to do it otherwise.
Well, but what? I think it's probably a good way with the multifamily market being hammered as hard as it is. I mean, we see a lot of that distressed stuff coming across our plate, and it's
Mhm.
just depending on what type of unit size you look at. Yeah, there's opportunities, and I think in some of the smaller units, but you start getting 100 and 200 and plus banks are not selling that stuff at a discount. There, and we've been buying debt. I used to buy a lot of that multifamily debt when I first started back in 2008
Yeah.
at big discounts, but the banks are not letting it go. And there's just, with interest rates being where they're at and the syndication market being hit very, very hard right now, it's kind of hard to raise money for that asset class too.
Yeah. Yeah, for sure. And that's definitely what we're targeting, that 8 unit to 50 unit kind of mark where the big institutional boys aren't playing in and a lot of the guys that have grown and scaled their portfolios are kind of graduated out of that too. They're looking more for that 50 to 100, maybe 200 unit play too, and kind of playing those against the big boys. And there's that gap between the guy who's kind of just getting started and getting a few duplexes to somebody who's got some cash and actually can close on these things and perform. And there's not as many of those people in there.
hmm Now, talking about Wisconsin, what are some factors up there? Not maybe you've only bought in Wisconsin. You mean it's like it's perfect up here. What are some of the things that you guys run into that might be different than other markets?
I mean, I think just speaking in general with other guys around the country that are doing this as well. Wisconsin's not overly tenant friendly. They're not overly landlord friendly. It's pretty in between, right? So you can get somebody out and evicted, send them a 28-day notice, and then you got at the end of that, I mean, the eviction process goes pretty quick from there. So that's one of the positives compared to some of the other, I would call them blue states where you're a year in before you're getting somebody evicted, or they don't even let you evict or something, some of those crazy laws out there. So it's still feasible to run a respectable rental portfolio here and do some things. Pricing wise, we're pretty competitively priced. Like you can still do bird deals here, which is my favorite exit strategy in real estate. And I know talking to some of my friends in like Phoenix and out in California and Colorado and stuff, they're like, burr's dead. You can't burr. And I'm like, well, come to Wisconsin, baby. We can burr all day long here.
No, no,
So
no. Don't come to Wisconsin. Just send your money to me in
yeah,
Wisconsin.
get on our buyers list is what I mean. Yeah, don't come and market here. Just get on our buyers list and buy the deals from us. So those are a couple of the positive things, and I think we're kind of an underrated state. You know, we don't have the big hedge fund guys coming in just overpaying for properties. So if you're looking to pick up deals, there's still deals to be had all over the state. So
well, and it's also too, you've seen a lower appreciation level, which means you haven't seen a bigger drop, a big correction as well
correct.
too. Would
Yeah,
agree with that. Yeah.
yeah, like most Midwest states, we get the graduals. So if we get a dip, it's gradual. If we get a peak, it's a gradual peak. But it's been COVID was crazy though. We were double-digit growth appreciation wise in COVID, like most places. But it was for us, that's pretty massive.
Yeah, I mean, you look back, I was looking at some numbers in Milwaukee and Madison and Green Bay areas, and you guys have seen, especially in Green Bay, it's been about a 5-6% year-over-year growth for the last couple of years, and it did spike in COVID.
Yeah.
Economists are saying it might be a little overvalued, somewhere between 13 and 30%, depending on the market and where it's at in there. I think that's a little high.
Yeah.
Same thing. They say the same thing here in Austin, that we're overvalued a little bit. And I would agree. We saw 15-20% spikes. But are you one of the things that you guys have similar here? We were talking about this before. As far as is property taxes are higher there compared to other states. Is that right?
Yeah, that's correct. I don't know where we rank, but we're not.
You're not on the low end by any means.
Not on the low end. I know that for sure. I know that for sure. And that's one area, you know, I've talked. I got a friend who's a representative in the state, and he's on the Ways and Means committees and stuff like that. And that's something like we've had a surplus several years. I'm like, why are we charging so much in property taxes? Like, let's work on bringing that down. But it's politics, man. That's about as far as I get into it as far as politics go. Just charge me less. And
exactly. Give me a bit of a discount. If we've got a surplus, we can afford to not increase our taxes year over year.
Yeah, it's mind-boggling.
Or give us a few more discounts on homesteads and stuff like that for sure. Even on your primary, at least.
Yeah.
One of the things that we've always cracked up is you mentioned Arizona. We had some buddies that were doing wholesale deals in Arizona. And they're like, "Oh, we're going to go to Wisconsin and do wholesale deals." I was like, "Well, make sure you check the taxes." So they're like offering the same formulas based on Arizona. And they keep getting hammered, and they're like, "Oh, the taxes are 5 times more based on the ratios." It's like, yeah, you're gonna have to adjust your bids down. You can't do the same approach, and every state's unique to that. I mean, we look at stuff buying distressed debt. Wisconsin's not bad, but we always got to say, okay, we're gonna have to do ask for more of a discount because of back taxes owed.
Oh yeah,
and working with the lenders or the sellers of those notes, say, hey, okay, they haven't paid in 2 years. We're asking for a 12 or 20 grand discount off what we would normally do because, hey, these taxes got to get paid and go from there. But that's a thing. I think what I see, like you do with any other Rust Belt, since you do have a lot of pride of ownership, you got maybe a little bit more elderly borrower. Would you agree to that? With a lot more people that have lived there, have equity in their houses as well, too, Corey?
Yeah, there's a ton of that, man. And you talk about like creating wealth. One of the things we teach a lot of the people who want to invest here, like we have to grow a lot of our investors. We don't have, like I said, we don't have like in Phoenix where you could have a buyer's list of 20,000 people and you put it out and it's gone in an hour. Ours are homegrown. We're teaching them a lot. We're doing a lot of education. That's why I started my podcast, was more so to educate people who are interested in getting involved in investing and especially in our area specifically. But one of the things we talk about is like, who do you know that's had a house here for a little bit, and most of those people have a lot of equity and they're not using it. So why not put their dead money to work and have them go pull a HELOC and you pay them some spread and let them put that money to work and put it into real estate, something like that.
Yeah, exactly. I mean, that's the thing. One thing we've been seeing a lot of across our is actually reverse mortgages from Wisconsin, where people have passed away and they've got equity. They tapped into some of the equity they had in their house, but they still got a bunch of equity. But the obviously, Green Bay, the frozen tundra of Lambeau Field, you got to take in consideration the subtle winners you guys have up there too, right, Corey?
They're very subtle. You won't even notice it. Yeah.
Because your face will freeze.
You think you're in Florida for a few months? Yeah, no. I actually get out of here in the winter. Usually, I go to Florida for a couple months because I'm weak like that, Scott.
That's all right. You've earned it. Where in Florida?
Down Tampa area. So we got a couple properties down there too. So we do a little Airbnb and invest down there a little bit as well. But everything
I like
else.
Tampa. I was just down there 2 weeks ago actually for a conference, and
Okay.
I love Florida in God's waiting room.
That's right.
It's where the snowbirds go to thaw out during the summer, basically. In
That's
the
me.
winter.
That's me. I'm one of the youngest snowbirds, I think, is as I've been called by some of the old folks down there.
Well, you're
So
not in the villages. That would
that's
definitely.
how you know you've graduated. You know, you've
But
lived a good life if you're in the villages, man. I'm telling you,
exactly.
it should be everybody's goals.
Right. Now let's take it back to Green Bay a little bit here on are you targeting more so newer built homes, or you've got probably a combination of some stuff that's been built and been around for a while too? So do you have to worry about different things when it comes to the rehabbing side of the Burr method with a lot of your leads and stuff like that comes through?
Yeah, for sure. I think that's one of the differences in Wisconsin versus, I'll just use Phoenix as another example, or even down in the where we are, Tampa area. A lot of these neighborhoods down there, it's cookie cutter houses. They were all built around the same time frame. They're all similar layouts. They're all built similar. Wisconsin, I don't know what happened when they started building houses, but they had no uniformity, no nothing. And so you're going to have a duplex built in 1880 next to some ranch built in 1960, there's no. So when you're running it makes it tougher to comp properties here. I feel like there's no formula that you can't, there's no cheat code where you can look it up real quick. I mean, it's a bit of a process to understand the market. For example, we started going down to Milwaukee and started marketing down there this year. And I mean, we got our butts kicked basically because we don't know the values there. And it's like street to street, literally on one side of the street, that house could be worth, like, no joke, $40,000. The opposite side of the street, it could be worth $400,000 on the same street. So you're looking at the address, you're like, oh wow, yeah, that's a great address. Meanwhile, across the street, there's a war zone happening. So
Mm-hmm.
it's just really interesting. The state is really interesting that way across the board. I don't know how else to describe
That's
it.
a nice way to put it. Interesting. That's the I part after the Burr is the interesting part of it,
Interesting
right?
part. Yeah. Yeah, exactly.
Now, with rates being where it's at on the refinance side, how have you adjusted your business in the last few years with refinance? Are you holding off? Are you working more with bringing in private money to help maybe offset some of the stuff, or what's kind of been your plan the last few years with
Yeah,
that?
kind of a combo of that. And we wholesale most of the properties that come through. So like last year we did about 140 deals, and all of those were wholesale deals for the
Okay.
most part. I held a few properties last year for tax purposes and stuff like that. But what I'm seeing the investors doing here is when 2023 happened, I think that's when it was, the fall of 2023 is when we saw the spike, right? And we had massive slowdown on activity. Like I couldn't sell you anything. It was tough. So we ended up actually flipping quite a few of those properties
Mm-hmm.
at that time, and we still did pretty well with most of them. We lost on a few of them, but most of them we did pretty well with. Yeah,
What, you didn't hit it out of the park and hit home runs on every deal you do, Corey? Come on, man, you're a loser. What's
unfortunately,
up?
I know. Unfortunately, it doesn't work that way. We call it dollar cost averaging, right? You do enough of them, you lose some, you lose some, yeah, whatever. But then
But,
we,
but but that's important. I don't mean to interrupt you, but that's such an important thing. Like I was just talking to a guy yesterday. He's like, "Oh my God, I can't." I'm like, "Dude, you're way scared about 12 things that have never happened yet. You're so scared about every possible thing, and you're not even going to be close to half those issues. Why are you so scared?
yeah,
About the unknown versus what actually is going to happen right in front of you.
right, right. Well, and I think part of it too is like we have some people, actually, some people on our team, and they're new, and I'm not advising anybody to go out and buy 10 deals tomorrow, right, without any experience. Like I think it's probably a wise choice to buy a few, get some experience, learn, go buy a few more, and then start scaling up. Point is though, is like if you are only buying one deal, it's got to be a home run, right? Where if you're buying multiple deals, or in your case, you're doing multiple notes, those types of things, some are going to lose, but some are going to be winners, and the goal is hopefully you have more winners than losers, and you end up coming out ahead, right? But if you just do one deal, my parents are a good example of this. They do, they're not even buying anymore. They get in too many fights now over the deals, but they bought a couple deals, and one of them they made like 20 grand on, one they lost, like, or they broke even or something. And I'm like, well, aren't you glad you did two of them? Because if you just would have bought the one you broke even on, you would think real estate is terrible, but you made 20 grand, pretty good. pretty good deal, you know? So
Yeah, there are a lot worse ways to make 20 grand to take a whole lot longer. You know what I mean?
yeah, or even lose money, right? I always
Yeah.
think I paid a lot of money to go to college, and what do I have to show for it, right? I'd rather lose money in real estate and learn something that way.
So are you a
So
Badger from Wisconsin based on the art of the podcast, I imagine, or no?
I did not. I'm a blue gold, actually.
Okay.
So Wisconsin Eau Claire is where I did
Okay.
my
Okay.
undergrad. I did do a little internship as a strength coach for the Badger football team, though. So I spent a few months there. And that's where I realized I hated what I went to school for. And I was like, dang it. Just spent 4 years doing this and I hate it. What was I thinking? So I
What?
rather,
So that's a good thing because we got a lot of folks out there with education and people going to school because we do have a younger crowd sometimes too.
yeah.
That aspect of we a lot of us go to school for one thing, like you said, and end up hating it, or don't want to do that. What advice are you giving your kids these days, or maybe they're not at that point yet, but
Yeah.
when it comes to it, what advice you can give your kids about college or what they want to focus on?
Like we're pretty easygoing. We homeschool and we're more about experiential learning, so to speak. I mean, yes, we should learn math and reading, and those things are important. But when it comes to like, do they need to know who our 17th president was? Probably not that important, right? Like, let's have them like start a business and learn how to do that, or just go talk to people like adults and look them with eye contact. Like that's pretty important stuff, right?
You may not be on this the entire time and
Y-
text people a question when they're standing right next to them,
Yeah, exactly. We are annoying to them though about ChatGPT right now. We get told that a lot. Like, you guys are obsessed with ChatGPT, and we're like, yeah, we kind of are. But you guys should probably start learning this now, and you're going to be way further ahead than we ever would
Well,
be.
that's what they say is some of the most higher paid people are going to be like the AI engineers, Chat
Yeah.
GPT engineers, knowing how to prompt and go there. What's a couple of things that you've used AI for in your business these days?
Probably one of the bigger ones for us is we set up our own GPTs to do call grading and call scoring. And so it'll take our VA takes, the call transcripts right now. We're trying to get that automated too, so that we don't have to have the VA going and do it. But and there's a Zap or something I think we can do. I'm not a tech guy necessarily.
Turbo Scribe. I'm going to tell you right now. Turbo Scribe is basically you upload the audio file. It's unlimited. What I pay, I think 9.99 a month. It's unlimited transcription, and it's so quick. Taking like I'll use TurboScribe with this audio just to upload the Zoom audio file. It'll transcribe it, and then I'll throw it into Chat GPT to make a 4,000 or 5,000 character blog and newsletter out of this. It's
It's
amazing.
amazing. Yeah. All right. I just wrote that down. Scott, we're going to implement that today.
That
Yeah.
we were able to help. That's
I
phenomenal.
appreciate that. Yeah. But then it puts it into the GPT we created. So I did all the training and stuff and uploaded all my training videos and scripts and all that kind of fun stuff, and plugs that in. And then it spits out. We used to have it do like it would give them a score on the first part and the second part and the third part and the closing and all that stuff. And it was too much. So we scaled it back. So it's just really I'm trying to just give them like two things that they did really well, two things that they missed or need to work on. And just, I try to get them to read it and actually go through it. We go through it weekly and
Yep.
look at them, but I want them to be reading it so they can make changes right there.
Are you a fan of the Wolf of Wall Street movie where he's standing in front of the mic, charging up his troops to go dial for
It's a
dollars?
great movie. Great movie. I love that movie. Yes. Classic. It's a classic. That's
The
not
book.
necessarily our culture at our
No.
office, but I respect the movie. Yeah.
Yeah, exactly. And the book is better than the movie, but the movie is damn close to it for sure
Yeah.
in a
Yeah.
lot of cases there. Um, you talked about obviously we're getting on your daughter's playing piano, your wife just walked in the background there.
Yeah.
How do you balance? Is the wife involved a lot too with the real estate stuff aspect of, or is more the handling the kids? Was she supportive of the front end of you making these changes when you started off a few years back, or were there some issues along the way as far as
Oh, yeah.
transition is never an easy thing in a lot of cases.
Mhm.
And the reason I ask that is we've had a couple investors reach out to me recently, like, hey, they're trying to do one thing and the wife's not supportive, and I was like, let's talk about that a little bit.
Yeah. Yeah. That we always say in most couples we see, there's a gas pedal and a brake pedal, right? And that's why they're a good couple, but it causes friction and tension, right? And we definitely experience that too. Now she's more gas and brake, which is helpful because I'm all gas, no brake. So she understands a lot of times, like when I'm coming up with like, oh, this is a crazy idea. She's like, it's not that crazy, like, let's see what happens. So she's
Prove
pretty,
it to me, like the prove it. How are you going to justify what you're spending on it? Is what my brake pedal does. You know what I mean?
yeah, she's not quite like that. She's just a little more like, let's try it. Well, worst that can happen. Sometimes she's obviously the voice of reason in this household if there is some really stupid idea, but most of the time she's pretty supportive. But she early on, it was her and I that were doing a lot. So she was more, how do I get the leads? How do I get the phone to ring? How do we track it? Metrics, all that kind of stuff. And I was just the sales guy on the phone locking up deals. We used to get in fights about that though. I'm like, we just need more leads. And she's like, well, we need to know where the leads are coming from. I'm like, no, we don't. We just need to get on the phone more. And she's like, you idiot. Like, we have to track where the leads are coming from so we know where to spend the money.
Where to spend the money on.
Yeah.
Exactly.
Yeah.
I'm always amazed when I'm talking to people and I'm asking, where'd you get the deal? Or, oh, I have no leads. Like, well, what are you doing are you reaching out? Are you calling? Are you emailing? Are you leveraging social media? Well, I'm not doing any of that. Well, like, how do you expect it to rain when you're not going to do any of the work that needs to be done?
Yeah, it's kind of important to do that. Yeah. So one of the things though, for those couples out there that are, or just business partners in general that are having some tension, Rocket Fuel, one of the best books that she read and told me about, because I'm an entrepreneur. I was like, I'm not reading that.
You got a Cliff Notes version of that
That's
I got to
exactly
listen
what I
to?
was like. Give me the highlights, baby. And then she's like, you need to read this chapter. I'm like, okay, read that chapter, and it helped me really actually understand her as more of the integrator role, and I was the visionary role, and it helped her understand more of me as the visionary in the business. And after we read that, I think there was like less tension because it helped us in our communication between each other. It was like, oh, she's coming from this place as the integrator. Like, that's a very important, valuable role, where I think I probably consciously or unconsciously devalued her role quite a bit because it wasn't the money making role.
Well, I think a lot of entrepreneurs do that. Oh, I'm making the money. I don't need it. And sales guys, we all
Sales guy.
do that.
We're all
Sales
like this.
guys, yeah,
Yeah. We got some egos, buddy.
just
We
a
got
little
some
bit,
egos.
man.
Yeah. It's true, but that really did help us a lot. And then we ended up, our first like full-time hire was because we were having another child. And so she's like, I'm not going to be able to send the marketing and do all this stuff after we have the baby. So like, we need to get somebody in here who can do this. So it's kind of out of necessity that forced us to do it, which was a blessing for us. And then she would come back in and like help, with meetings and annual meetings and quarterly meetings and do these types of things. But now I think it was about a year and a half ago, she fired herself and was like, I'm not involved anymore. I want nothing to do with it. Not in a bad way, but just like, I need to take care of the kids and make sure our house is good and do all these things.
But that's a beautiful thing about that is that you've built that up and being able to do that. Not a lot of people are able to do that because they get tied into needing two careers to pay for everything, and you guys have built your business up with that in mind, obviously going back to your goals to get to that point where you got averaging $200 of cash flow times 200 will get you to the point where you need to be, which is phenomenal, and you obviously adjusted your business to make things happen.
Yep. Yeah. And now it's a really cool, like, this business is so amazing because now she can focus on the kids, but now it's also allowed us to hire a helper. So somebody to help her with the homeschool stuff. And now, like, her vision, she's, like I said, she's also got visionary capabilities. Now she's creating a preschool in our community that it desperately needs one, and a homeschool like resource community center type of a thing, which is serving a huge need. She's she just launched it last week, I think it was, and it's already almost full with all these classes she's offering on all these other things. So it's really cool to see her be able to now use all of her gifts and abilities and still get fulfillment from not just being a mom. I don't mean that in a demeaning way, but like sometimes it's, that's a thankless job in a lot of ways, and no real way to track KPIs in that, where, so it can be a little draining to just be
the KPIs kind of come like when the kids turn 18 or the good kids. You know I mean?
You don't get your KPIs until they're 30. It's a little long delayed gratification there.
Mm-hmm. Now, with the podcast, what's been your biggest surprise from the podcast and having that going for a while now?
Honestly, the biggest surprise is how hard it is to get people to listen to it. To be honest, like, I thought it would be the other way. I was like, oh man, everybody in our market, like, we've got 3,000 people on our buyers list. They'll all listen to this. It'll be awesome. And then I like check the metrics all the time. And it's good. Like, we get consistent people listening to it. I think we put a good product out.
Yeah.
But it's just, I commend you, man, for how many you're putting out and how much content you put out and how many how many people you've got that listen. I mean, that takes a lot of effort to get to that point.
Well, we've used some things like when we first started off years ago, we did 150 days of just Facebook Lives to build an online audience back in the day. Back in 2000, this would be 2016. We did that for basically 5, 6 months, and then
Oh,
it built an audience, and then we've just got a big email list that everybody goes out and gets focused on emails. Another thing that works well too for you, you might like, this is a little trick. Are there
okay.
other like real estate conferences or expos or things that are taking place in your area?
We do like local meetups and stuff. Like we run one.
No, no,
Yeah.
not you, not that you run, but like the home show or the hot
Oh,
tub show or big, like, we have that that rolls through, some of the bigger cities and stuff like that.
yeah. Yep.
One of the things that works well, we've done this in different times, is we'll do a geo targeting through Instagram and Facebook. So within a
Oh.
mile of the conference center,
Oh.
on the 3 days or 4 days that the event is running, and just run a short budget, cheap budget
Yeah.
of targeting people that are invested in real estate and investing off of like Facebook, and it targets them on their social, because people are all sitting around half the
Yeah.
time waiting for a spouse to finish up doing something or walking through, and it's a
Yeah.
free lead gen into, hey, how to buy your first investment property, or how to uh,
Is
rehab your property, and that saves me from ever having to go to conferences again, because you just target things like that, and
that's
that
awesome.
helps. You
Just
know,
wrote that down too. I'm getting a good list here. I need a new piece of
I
paper.
am adding value. I love it. I love
Yes.
it. Love it. But that's an
That-
easy thing that people don't know. I've talked about that twice. I talked with another group yesterday at New York. It was kind of funny. As a podcast with two guys out of New York and one guy's from London. Well, his visa expired, so he didn't go home to London for a year before he could reapply to
Oh
go.
my goodness. Wow.
Multifamily investors. It's a little hard to do the walkthrough. Yeah, it's very tough to do the walkthrough from London.
Wow. That's incredible. Hey, I'm glad I don't have that challenge. You know?
Amen to that. Amen to that. Now,
Yep.
down in Tampa, the Airbnb, you're doing a little bit of that out there. Has that
Yep.
been affected with the market being kind of crazy in Florida recently?
Yeah, we have one house that we stay in down there, and then we just started doing more longer term rent because we're in an area where you can do 3 weeks of Airbnb, and then outside of that, you got to have longer term tenants there. We had two other ones that were just strictly short term rentals. We sold one off right before the hurricanes last year, I think in May of last year. I heard this little line, and I don't know if I'm in a mastermind group called the Collective Genius, and I don't know.
I
I
know
think
the guys yep, been there
yeah.
before. Yep.
Okay. And so one of the guys on stage, I don't remember who it was, but I remember one of the events, he said, I'd rather be 3 hours early than a minute late. And that stuck with me. And I remember this property, and I was like, insurance is getting tough down there. Property taxes are crazy down there. So the costs have been going up. And I was kind of worried about insurability on this thing. I'm like, if we lose insurability on this thing, we're screwed. So I don't know what we would do. And so I decided, let's just sell it. It was a good money maker, but I'm like, let's sell it off. And we found a guy, bought it, closed on it, and then sure enough, boom, hurricane comes. And I don't know what kind of damage it got, but it was right by the intercoastal. I'm sure it was not good there. So we got
A
really,
little bit of moist carpet, basically.
yeah. And it was low. I mean, it was in a flood zone, all that stuff. So we got rid of that one. The other two we have are on higher ground. They're little, like any hurricanes that have come through there, there's, yard damage and stuff. But outside of that, the properties have been fine. But we have seen it soften a little bit with the Airbnbs down there. I don't know if it's oversaturated or if it's just less demand or what's happening, but over the last year or so, we've definitely seen it a pullback, maybe to a normal pre-COVID range. I don't really know.
It's just a correction in the market. I mean, the Wall Street Journal came out with an article about Cape Coral being the worst real estate market in the country right now, based on saturation and
Wow.
sales and days on market. And I like Southwest Florida. I've bought a lot, owned a lot of distressed debt down there in the days. I've bought a
Yeah.
lot in Florida, a couple hundred assets down there. But I think it's correcting. You're going to have a crash, which reminds me of 2008, 9, and 10 again. There's going to be some deals out there that I could pick up at a much cheaper price.
Yeah.
If I have to self-insure, let's make sure we're buying at the right price to cover that if
Right.
we need to. But I don't think I would be buying any waterfront property right now in Florida for a while. Probably more inland, like Orlando, that
Yeah.
neck of the woods.
Yeah. I mean, although you could probably pick some up really good deals right now. So I know that was a big issue. Some of our friends down there, man, they got a bad deal from their insurance people, and now because of the laws or the conform, I don't remember exactly what it was, but now like if you're over 50% damage or something, you have to like rebuild at the current thing. So now you got to
Building
rip the
standards,
house
yep,
up. Yeah, it's
yeah.
like, I mean, you got to have six figures laying around pretty accessible that you had no plans for, to be able to do a lot of this stuff just to cover what the insurance won't cover.
Yeah,
So
exactly. Otherwise, you're bound to go with the insurance that the state of Florida offers, and that's not cheap. You know,
I
kind of like
know.
what California's dealing with the fires and everything out there too.
Yeah.
So, but you know, what made you decide that you were going to do that down in Tampa? Did you just like traveling down there? Obviously, you wanted to get away for the warm winters down there, but what kind of research did you do prior to going down?
None.
Okay, that's the
Yeah,
best
well,
way. Great advice, everybody. Don't do
yeah,
any research on a market.
yeah. Well, okay, I shouldn't say no research. We spent 2 weeks on a vacation down in that area, Madeira Beach area, specifically Treasure Island, that neck of the woods by
Nice.
Tampa. And we just loved it. My wife and I loved it. We're like, man, then we play this game called Stupid Idea Time sometimes. And we're like, hey, stupid idea time. Like, what if we just bought a house down here? We lived down here a couple months, and then Airbnb it the rest of the time to pay for itself. And we're like, yeah, why wouldn't we do that? Makes total sense. And then we started shopping like right when we got home from that trip. And we got really lucky when we bought. We bought right when COVID was happening, like at the early part of COVID. So there was a lot of uncertainty in the market. We got actually a discount on the house. It was built in 2016, so it was only 4 years old. I mean, it was perfect. And then after COVID, it almost doubled in value from when we bought it. So I mean, we got very fortunate to buy when we did. But
You know, there's always a case of opening one LLC for your business and just basically using, was it the 14 days a year that you can have an LLC
yeah,
rent out your house at convention level for meeting space to
yeah,
offset the costs or the
yeah,
losses and stuff like that? That might be
yeah,
something to think about.
yeah. I think they call that the Augusta rule or
That's
something.
exactly right. Very
Yeah.
good. Ding, ding, ding.
Ding,
Corey
ding,
knows.
yes. Yes. I win the trivia today.
Uh, phenomenal, phenomenal stuff there. So you guys are doing some great stuff. Your wife's rocking education for the kids there, because I found that a lot of real estate investors are homeschooling kids too. I don't have any, but I've got a lot of friends that are doing that because they're fed up with the education systems and wanting to really give kids an opportunity to learn versus based on some tests that they have to pass in a lot of cases out there,
Yeah.
man.
Yeah, for sure. Yeah, for us, it started out as a lifestyle thing of just being able to go to Florida. I mean, that was a big piece of it, is get out of here for the winters and go down to Florida. And when you or when you're in the public system, they call that truancy if you're gone for too long, I guess, and the parents can go to jail. So we're like, yeah, we don't really want that. So
Yeah, don't get that. I just don't get that in some cases. So yeah, very
yeah.
good.
So we're like, well, we'll do the homeschool thing. And then we got lucky because again, it was like a year before COVID when we started homeschooling, and then COVID happened, and we're like, well, we're no disruption to our life at all, really. It was just normal day to day. But it's been awesome. And now like the schools are getting crazier and crazier, we feel like. And the more we're in the homeschool world, it's not like the weird homeschoolers of the old days,
Yeah.
not knocking anybody who's a weird homeschooler, but
Come on, we all know they're a little social, rough in a lot of
yeah.
cases,
Well, and that's like a lot of the criticism like we get from people who don't homeschool around here. They're like, well, aren't you worried about your kids being weird and whatever? I'm like, you mean like at public school where you got the cat kid? Like that's not weird. Okay. Just checking, right? And
Right.
our kids are around adults all day. So it's like they can hold conversations better than any kid that's their age that's in public school right now. So it's pretty cool to see that
That's pretty.
for a while to see a little bit of the fruit, a little bit of the KPIs coming out here.
That's good. That's good. What's your big goal for the rest of the year, Corey?
Man, our goal this year, we got a top 4 million in revenue in the wholesale business. That's number one goal. That's what we're really focused on. Like I said, last year we did just about 4 million. I think we were like 3.5. I used to set the goals like crazy, like 6 million, 8, 10 million, whatever. And then, again, got a little realize like that because it's kind of deflating to the team when you get to July and you're not even a third
Halfway there.
Yeah. So we adjusted the
Well,
goal.
sales guys, I can tell you like me, you set a big goal, like you shoot for the stars, and if you hit the moon, you're still out there. You're doing a
That's
great
right.
job. Or shoot for the moon, hit the stars, whatever that analogy is. But
Yeah.
yeah, sometimes you've got to, bring it back to earth a little bit. Okay, let's hit some real estate goals, and then I'll double it up the next year, what you
Yeah.
guys are really capable of.
Yeah, exactly. Well, the other piece too is this multifamily facet. I want to get back to. We have 140 doors right now. That's where we're sitting at, and I'd love to get that to 200. Not for any particular reason, but more so just a personal challenge to try to get there. And it's not that lofty of a goal. Again, it's not 1,000 in the next 6 months or something crazy.
Right.
It's pretty
Now, when you look at, I know you said you're wholesaling a lot of stuff. You still got some stuff that you hold on to. what's a cash flow number per month that you really like? I mean, you mentioned trying to shoot for 200, but
Mhm.
if you've seen something that's at 300, 400, that's something more that you would look at more of a long-term hold for you, or still flip it. I mean, it's an asset by asset basis, obviously, but
Oh,
cash flow play wise.
yeah, you talking about like on a per deal basis?
Yes. Yep. Yep.
Yeah, I mean, for me, honestly, because we have I guess you would call it the cash flow business of the wholesaling, that produces a good amount of cash every
Yep.
year for us. For me, when I'm evaluating a deal now, I'm more so looking at, can I burr this deal and will it break even every year? I don't
Right.
really care about the cash flow from it right now because I understand rates are higher. I understand, but I'm getting 20% equity if I can burr this thing, and I'm in the long wealth building phase with that. Plus, I'm going to get now that we have the big beautiful bill signed, now I can cost seg that if I want to and take 100% bonus depreciation to offset a lot of the cash from the wholesaling business. So that's more so kind of how I'm evaluating them now than when I first started out. The $200 a door. The $200 a door is kind of just a metric that
That's what a lot of people talk about, the $200 a door, and it's never like that because there's always
oh,
something that pops up, is there? Right.
always something that pops up. And I tell you what, like my first 16 unit apartment, I was like, I've made it. I bought a 16 unit. Like I'm graduated from the duplexes. This is going to be amazing, right? And I'm going to cash flow so much money on this thing. And I don't think I actually put money in my account until like 3 years later.
Wow.
Every month it was going back to like a new unit had to get turned, and then this had to happen, and then a roof went, and then this went, and this went. And so just like one thing I underestimated when I got into the multifamily game was just how much CapEx you really need to budget, right? It's not like a duplex where you spend 30, 40 grand and you're good for a long time. It's pretty consistent. And then you might rehab it, and 2 years later they destroy it and you got to go do it again in these units. And so there goes another 10, 15 grand again on the unit. And so that was something I didn't learn, but I did think about cash flow a little different, Scott. You tell me if you agree with this. When I refinanced that thing 2 years later, I didn't put any money every month. I used to think of monthly, like, oh, $200 goes in per door. Oh, this is the cash flow. But then when I refinanced it 2 years later, I pulled out like 240 grand tax free, essentially, unless I sell it. But at that point, I was like, wait a minute, 24 months, 240, that's 10 grand a month tax free from doing the refi. That's where my cash flow is. It's just longer. I just got to wait a little while. Let the
Just that's
10.
why I love that's why I like being the bank, the paper game. You play the paper game just a little bit differently on the back end side. That's why I like about notes is that we're not doing the rehabbing the property a lot of times. We're just rehabbing the borrower and keep them in there, and we're shooting. 250 is the minimum we're looking for. That usually it's 400 to 500 without having to have any ownership. Obviously, the backside is that you don't own the property, so you don't get the depreciation, but you're buying the debt. It's usually a big discount. So if they do refinance you out in 5 to 7 years, you're getting that big payday on the back end. Or
Well,
if
and
they
like
sell it,
you just mentioned a big benefit is not having to deal with the rehab of the property. I mean, getting contractors nowadays, it is a
so
nightmare.
difficult. Yep.
It is a nightmare. The note stuff is like the graduate, like you're playing in the graduate league where everybody tries to get to at some point. Like every investor I know who's been in the game for a while eventually graduates to paper. Like they get out of the tenants and contractor business.
Toilets and
Yeah,
termites
and
and rehabs. Yeah.
they get into the note biz. Everybody does. So you're in the
Well, I tell you what, we do see some stuff up that neck of the woods. I see something, and I'm going to call you up and say, "Hey, let's take a look at this. Maybe partner
yeah.
on it and go from there, brother." All righty.
Would love to, man. It'd be awesome.
Well, now you've got on your the podcast website, you've got a free Burr class available for
Correct.
folks. Is that still correct? Yep.
Yeah, that is correct. Yeah. So we used to charge, I think, 3 grand when I was doing more one-on-one coaching with it. So I would do or group coaching with it. And then I was in Florida doing it, and I'd have like 3 people on the thing. I'm like, I'm not sitting around in the middle of the day in Florida. Like, here's my cell phone, call me, kind of thing. And then we were doing just the course, the modules and stuff like that for 1900. And then recently, a couple weeks ago, I was like, we should just give this thing away. Let's just give it away for free. So people who join our buyers list, they can join the buyers list, and then somebody from our team will have a conversation with them, kind of feel out their goals. What are they trying to accomplish? Try to get them connected to lenders, property managers, all that kind of stuff. And then if they're interested in doing the Burr process, we get them set up with the Burr course, and we just give it away now.
That's awesome. Good stuff, brother. Best way for folks to follow you, connect with you, see what you're up to.
Yeah, I mean the podcast is probably the best way. So I think the Wisconsin Investor socials we're all over all the
Yep.
TikTok, YouTube, all that fun stuff. If anybody wants to connect with me directly, I don't really go on Facebook anymore. I was a guy that does that for me, and so if you see posts, that's him, not me. But I still have Messenger. So if you message me on Facebook Messenger, that will be me that responds to you. So it's probably the easiest way.
Good stuff. We'll put that all in the episode and stuff like that for folks to reach out to. Link to the podcast. Make sure you check it out, guys. Great podcast weekly. The Wisconsin Investor Podcast. Look for the Wisconsin Badger with a cheese head is That's the right. artwork on it. It's great stuff. Definitely good branding on point there for you, buddy. So this has been fun, Corey.
I agree.
Good stuff, buddy. We got to continue the conversation here sometime soon, or get together when I'm down in Tampa or you're down in Florida, or even up in Wisconsin. You guys have was it apple season here shortly in the next few months, something like that too?
Apples, cherries, yeah, all that good stuff.
You gotta love it.
You bet. Love it. Yeah.
Go Packers.
We're going to get you on the podcast here shortly. So you guys get to tune in and we get to flip. We get to flip flop.
Flippity floppity. Exactly.
That's right.
Good stuff, buddy. Thank you so much for coming on, man. It's been really insightful. Enjoyed the conversation, bud.
Same here, man. Appreciate you having me.
Yes, sir. All right, everybody. Hey, go check it out. If you're like the bird strategies, one strategy you're wanting to implement, because you can do that in a lot of places that it still works. Depending on where you're at market and what you're focused on, but check it out. As always, guys, thanks for listening. Make sure you go check out his podcast as well. And if you have any questions about that, feel free to reach out to him, but go out, take some action, everybody, and we'll see you at the top. Bye. Hey, real estate investors, this is Scott Carson. I'm known across the country as the note guy, and I've been an active note investor focused primarily on the niche of non-performing notes, distressed mortgage notes on residential commercial properties for almost 20 years now. My company is weclosenotes.com. And I know there's a lot of different things when it comes to the note world. Are you buying performing notes? Are you buying owner finance notes? Are you buying institutional debt like I would focus on? Are you buying first, seconds, contract for deeds? There's a lot of questions. And it can be very confusing about what you can or cannot do. So one of the great things that we've hosted for the last couple of years that we do on just about a regular monthly basis is we host our one-day class called Note Weekend. If you go to noteweekend.com, you can register for a free 3.5-hour class. We'll talk to you and share with you how you find, fund, and flip non-performing notes. And yes, you can buy non-performing notes from banks, hedge funds, and a variety of different hard money lenders out there for your own portfolio. No, you don't have to have millions of dollars to dive into the non-performing note game. We've got students that have bought plenty of deals with 25, 30 grand, getting their ball rolling, using their self-directed IRA, who are tired of dealing with toilets, tenants, trash outs, tired of battling contractors and GCs to get properties rehabbed. We all know the market is changing. And while it may not be like 2008, 9, and 10 again, we do see a lot of distressed debt out there on both the residential and the commercial side. So if you're thinking about diving into the note game, becoming a note investor, a lien lord, as you like to say, versus a landlord, or you just want to figure out what it is about the sexy side of real estate in the note space, well, check it out, noteweekend.com. Doesn't cost you anything. We host it live, usually the first or second Saturday of each month. You can go today, register at the website, noteweekend.com, register for the next live class that we host. You'll get sent a replay of the previous class so you can start learning about the note business today. No questions asked, no credit card needed. This is a great way for you to dip your toes in the water and see if it's warm, because I guarantee going through our one-day class, you want to dive into the deep end and become a note investor. So check it out, noteweekend.com. You can also go to our website, weclosenotes.com. Check out our podcast. Check out our #1 YouTube channel. We are here to help support you. Whether you're an experienced investor or you're brand new to investing, Note Weekend is a great place for you to get the ball rolling. People often say we cover more in our 3-hour class than most people cover in their 3-day class. So check it out. Love to have you be part of our Note family. But get signed up today at noteweekend.com. Thanks and have a great day.